For decades, the tech founder lifecycle followed a predictable sequence. You build a product in Palo Alto, scale it in the cloud, and eventually sign the exit paperwork in a boardroom on Sand Hill Road. By 2026, that sequence has fractured. Founders are still securing liquidity events, but the moment the deal closes, they are moving their base of operations out of California. The financial logic of remaining in the state has shifted. When you combine a 13% state income tax with rising municipal volatility, keeping your wealth parked in the Bay Area yields diminishing returns. The new capital pipeline flows towards Southern Europe. Jurisdictions like Italy, Greece, and Malta have engineered legal frameworks specifically designed to attract builders and visionaries with low tax footprints and high-trust environments. The objective function for a founder has changed. Securing a buyout is now only the first step. The true measure of a successful exit is finding a jurisdiction where you can legally keep and protect that wealth. Migration agencies sell this transition as a seamless vacation package. They present images of Tuscan villas and Aegean yachts, framing the move as a simple trade of high taxes for Mediterranean leisure. That narrative ignores the legal friction of moving a financial estate across international borders. This chart plots the core trade-off every founder must evaluate. On the horizontal axis is your total tax burden. On the vertical, global mobility. Silicon Valley places founders in a high-tax, moderate lifestyle quadrant. Southern Europe sits in a different quadrant, lower tax drag, higher global mobility. Getting from the US quadrant to the European one requires discarding the lifestyle brochures. You have to evaluate the strict mathematical realities of the programs in Italy, Malta, and Greece to see if your balance sheet justifies the move. This comparison matrix breaks down the three primary pathways. We'll start with Italy's lump sum tax program. The requirement involves transferring your primary fiscal residency to Italy and paying a fixed annual fee directly to the government. In exchange, Italy shields your global income and dividends from any percentage-based taxation. Because the fee is a fixed flat cost, it creates a significant drag on mid-tier wealth. If your annual passive income isn't generating multiples of that fee, the program yields a negative return on investment. This structure is designed for a specific profile, the whale. These are founders walking away from nine-figure liquidity events who generate massive, continuous global income. For founders at this level of wealth, the high fixed fee becomes a minor overhead compared to the percentage-based taxes they would face elsewhere. Moving across the matrix, Malta's citizenship by investment pathway solves for a different variable. The barrier to entry here is a large, non-refundable direct investment into the Maltese economy, followed by rigorous due diligence. The return is speed. Within 12 to 36 months, you secure full EU citizenship. You sacrifice liquid capital with zero expectation of a financial return to gain immediate global access. Greece takes a different approach. The Greek Golden Visa requires you to park your capital in qualifying local real estate. Instead of a sunk fee, you acquire an asset and a backup residency. The trade-off is patience. It does not grant immediate citizenship, and it exposes a portion of your net worth to the local property market. It's a clean dichotomy. Malta requires dead capital in exchange for instant global mobility, while Greece requires you to anchor your wealth in physical assets for a slower foothold in the EU. Securing the European visa is only the final step. The actual hurdle is extracting your intellectual property and corporate entities from the United States. The moment you renounce your U.S. residency, you trigger the IRS exit tax. This assigns capital gains penalties on your global assets as if you sold them all on the day you leave. To navigate this, founders rely on intermediary corporate structuring, frequently using the United Arab Emirates as a base for tax-efficient holding companies. This chart illustrates the required legal sequence. First, pre-exit U.S. tax planning. Second, establishing a transitional corporate entity in the UAE to hold the assets. Finally, executing the European visa for your physical residency. Operating this structure is a permanent obligation. Maintaining compliance across 3 jurisdictions requires expensive, ongoing legal support. Achieving Mediterranean tax benefits requires you to manage a complex multinational corporate structure behind the scenes. This scorecard aligns your specific founder profile with the correct legal strategy. If you are the whale navigating a 9-figure exit, the Italian flat tax is the most efficient choice. The fixed fee is easily absorbed by the sheer scale of the percentage-based taxes you avoid. For the speed seeker, those who need the lowest friction path to global mobility, Malta is the target. The sunk cost is the price of rapid EU access. If you are a Plan B executive prioritizing family security and asset diversification, Greece provides the most stable method for establishing a foothold without forcing an immediate lifestyle change. However, the overhead costs of this transition create a clear floor for entry. When you calculate the upfront exit tax hit, the cost of UAE corporate setup, and the six-figure annual maintenance for international compliance, the savings diminish for smaller exits. For an exit under $10 million, these legal and structural costs often eclipse the actual tax benefits, making domestic relocation a more sound financial move. Ultimately, migrating your tech wealth to Southern Europe is a highly specialized maneuver. It only succeeds when the mathematics of your liquidity event directly justify the legal complexity of the move.